Hey guys, Toby Mathis here, and today we're going to talk about 5 tax acts that you can use to save huge in 2025. Let's dive right in it. Number one, the best tax strategy ever, period, bar none, is to get involved in real estate. And why is that? Because there are ways to take massive deductions on paper off of real estate and to offset other income. You can also borrow against your real estate or any asset for that matter, but real estate's the one that people tend to understand and not pay tax on that income. So at the end of the day, what you end up realizing is that there's this accumulation of wealth that occurs that I'm able to get massive benefit from during your lifetime, including using, and there's 3 strategies, using losses from real estate and creative strategies like using cost segregations and bonus depreciation. Watch my other videos for those. There's a whole bunch of tax strategies we could use. But what it does is it creates paper losses that then we can use to offset our other income. For example, there's 3 that we really focus on when we're dealing with real estate. Number one, active participation in real estate. So if you are somebody who's making less than $150,000 of adjusted gross income every year, then this is a possibility to write off up to $25,000 of real estate losses from that real estate. And you could use it against your W-2 income, or if you're a sole proprietor or in a partnership or in an S corp and you have other types of income, or you're getting paid a wage from an employer, you could use those losses to offset your other income, even though you didn't actually lose money. This is really important. You just have a rental property, but you're accelerating that depreciation and you're creating a paper loss. You could use it to save money on your taxes. So that's an easy one. All you have to do is be in control of that property and managing the manager. That's it. The second category is real estate professional status. And that is for those of you who are in real estate trades or businesses. The IRS under 469C7, section 469C7 of the Internal Revenue Code, gives us a bunch of different businesses. I think there's like 11 in there that actually qualify, but the most common people understand are things like being a real estate agent or real estate broker, being involved in construction development. Now there's a 2-prong test here. And again, I've done videos on this. Look at my channel for some of the other tax strategies, and real estate professional status is a big one, where you're doing at least 750 hours in a real estate trader business, that you are at least I think it's 10% shareholder. It might be 5% actually under this particular test, where you are a part owner in, and you get to use the time that you spend in that business as long as it's more than 50% of the total time you spend on services during the year. And by the way, one spouse has to qualify for this if you're married. So 750 hours, more than 50% of your time has to be on a real estate trader business, not on your properties, on any real estate trader business, so long as you are a part owner in it. Then it unlocks all of the real estate losses you have that would normally be considered passive losses, and it makes them non-passive, which means in English, let's say you're making $200,000 a year from a job and you have $50,000 of paper losses from the real estate that you're involved in, then you could take that $50,000 of loss and offset your $200,000 of income. Voila, you're only paying tax on $150,000. So you have the 750, 50% rule, and then you have to materially participate on your rental properties, which just means there's a number of tests that you could qualify for. The most obvious ones are, hey, I manage the properties myself, or there's other people doing substantial services on those properties, but I spend with my spouse and I combined at least 100 hours, and nobody's spending more time than us. There's another test, which is 500 hours, which again, depends on your circumstances. We look at the different tests and see which one you qualify for. I think there's 7 of them. So you do that, boom, you get to use those losses. Now, number 3 on that one, and we're only on the first tax act, which is real estate, but there's 3 ways you get losses. You get the active participation, real estate professional, and then number 3 is short-term rentals. And what that means is you are actually treated as a business. And with any business, so long as you materially participate in that business, which again, there's a bunch of tests to materially participate. If you're running it yourself, you automatically qualify. But if there's other people providing a bunch of services, so long as you do more than 100 hours and more than anybody else, you qualify, or 500 hours automatically qualifies no matter what anybody else is doing. But as long as you are involved with those short-term rentals, you materially participate, then again, losses off of those short-term rentals. And what is a short-term rental? 7 days or less average usage. So if you're doing an Airbnb, the average is about 3 days statistically. But let's just say you did 20 leases or 20 guests, individual bookings, and it was 100 days that you rented it. You take 100 divided by 20, that's 5 days. So that's a short-term rental. That is a business. It's not rental activity anymore. It is a business. And so the losses would be treated as non-passive. They could be used to offset your income. So same scenario. You have $50,000 of losses because you had a really nice property on the water that you Airbnb'd, and you did that. Let's say you only did it for 3 months out of the year. You bought it towards the end of the year. Fantastic. It doesn't matter. We would accelerate that depreciation, take that bonus, boom, and use that $50,000 to offset your other income. By the way, you could do this with a high income taxpayer. So if you're a surgeon or a manager in a business, or you're an attorney, a dentist, a doctor, some high income profession, you could use that short-term rental loophole and use it to offset a bunch of your incomes, because you do not have to meet that high standard of real estate professional. You don't have to worry about phasing out of the active participation that phases out after $150,000 of adjusted gross income. You could use that short-term rental, and a lot of professionals do. Even if later on you change that property to being a long-term hold for that year, you get to unlock that loss. And if you accelerate the depreciation in that year, you can use that loss to knock out a lot of your income. And I know that's a lot for some of you guys to think about. Some of you guys are following along that are real estate, this stuff. Spend some time on my channel and all these things will start to make sense. But this is a huge tax hack in 2025 that anybody could use. And with a little bit of being deliberate in your real estate, you can get some serious benefits. Number 2 strategy, number 2 tax hack, probably one of the best tax hacks out there, is owning a business, because owning a business unlocks the door to your ability to reimburse business expenses that you haven't been able to write off. Ever since the Tax Cut and Jobs Act came out, we have unreimbursed business expenses that we can no longer use. We don't have miscellaneous itemized deductions. There's all these things that went away. Some of the things that are still there is this ability to use assets that you have. Like, hey, let's say I have a cell phone. I can use it in my business and reimburse myself 100% if you are structured correctly. To do this, it's only available to corporate entities like S Corp, C Corps, LLCs. Taxed as either. Even nonprofits qualify. You can't do this with a sole proprietorship. You have to do this where you're an employee of the organization, and you can use what's called an accountable plan. It also unlocks something called the Augusta rule to be able to use your home for your corporate meetings. You can reimburse yourself tax-free there up to 14 days. And you also can have an administrative office in your home where you're getting tax-free reimbursed use of your house. It's usually up to around 15% to 20% of all the expenses in the home that you could actually reimburse yourself. These things are fairly massive when you apply them, but you have to have a business, a family office managing your other assets can control, or you have a side gig, or you're doing something with your family. And you could have multiple streams of income inside that one business. But the idea is to have an actual business. And then you have the accountable plan reimbursements. You have the 280A. You have an administrator from your office. Things like your equipment, your cell phone, all those things become tax deductible reimbursements. You get to reimburse yourself 100%. Like, if I'm a sole proprietor, I got to track my business use and my personal use. If I'm an employee of an organization, it just gets to reimburse me 100%. Subtle difference, big impact, but it's by having that business. So number 2 is having that business. That's a huge tax hack. Number 3, and this is especially if you have a business, retirement plans. Those retirement plans include things like a defined contribution plan, which means I'm defining what I'm putting in it, What are examples? Your 401k is an example. Hey, I could put in, what is it this next year? You're going to be able to put in 23,500. It's a large amount that you're going to be able to put in there as an individual. You can get up to $70,000 total per business. It's not total for the year, but if you have multiple 401ks, I got one with this employer and I got one with my own business, you could actually put 70-70. You can only have one employee contribution amount, but the rest, the business that's putting in and getting that nice deduction, you can actually do as many as businesses as you have, so long as you're able to work for that business and actually get active wages. You can put it into that 401k. Those things are absolutely fantastic when you do that. IRAs, I think it's $7,000 you could put into your traditional IRA and take a deduction, or you could do a Roth. A lot of people are preferring that Roth, especially if they know that their tax bracket is going to be higher later. So if you're just getting started out and you're in the lower tax brackets, those Roths are particularly effective, even though some people, even in the higher brackets, I think they're wrong to do it, but they still do it. They convert and turn into Roths. But you can do a defined contribution plan, or the retirement plan that's on steroids. That is absolute. We have clients that put hundreds of thousands of dollars a year into these plans. It's called a defined benefit, when you're using an actuary to define what would I need to have in my retirement plan in order to continue to pay myself what I'm getting paid now. That's going to be the simplest way I can explain it. If you're making $200,000 a year now, how much do I have to have when I retire to continue to receive $200,000 a year plus inflation? Right? They're tracking these things. It might be that I have to have $3.5 million sitting in that plan. There's going to be some maximum amount, and they only allow you to use, I think it's $300,000 a year this year of what the actual benefit could be. But if I'm making $200,000 a year and I have 10 years to put money into a retirement plan to where I'm going to retire, that means I could put, just simple math, you're looking at least $200,000 a year that you can put into a defined benefit plan. And yes, we have clients that are doing substantially more. The group that I work with the actuaries, they're really interesting. They actually have somebody who's putting in over $1 million a year, tax deductible. It's tax deferred. They'll pay tax when they take it out through retirement, which is usually about 4% a year. When they're retiring, they're taking out of that retirement plan as required minimum distributions. They'll pay tax on it then. But right now, they're getting a massive tax deduction. If you're making that type of money, you're in the higher brackets, and it's really frustrating when it feels like every dollar you're giving up 50 cents. You might be giving 37 cents to the feds and your state. A defined benefit plan is a fancy way to knock that off and to put that into a retirement plan that can then grow tax deferred, and then you pay as you take it out. So there are retirement plans. Do not forget, if you are an employee, make sure if your employer is offering you matching, that is 100% return. There's nothing better. And you're getting a tax deduction when you're putting money in. Make sure that you're taking advantage of that. But if you have your own business, you could attach a retirement plan to it, a solo 401k or something right to it, and make sure that you're not paying any tax on the money that you're making. Number 4, and basically almost everybody can do this. I don't care how much money you're making, do an HSA. And a health savings account is a fancy way of saying you could put, I think in 2025, it's $8,550 per family, $4,300 for single. If you have a high deductible plan, which, I think it's $1,600. And if you're an individual, and somewhere around, what is the maximum? I think it's double that for a family, so $3,200. If you have a high deductible plan, which almost everybody does have nowadays, then you can use an HSA and you can get this deduction. It doesn't matter if you're making $1 million a year or $50,000 a year. You can still put that money into that plan. And here's where it's super potent. You get a tax deduction for putting that money in. So let's just say I have a family and I put $8,000 a year in. Okay, and that $8,000 grows over the next 3 decades. It grows and grows and grows. And that 8,000 becomes 80,000. I pay no tax on that growth. And if I take it out for health services, no tax on that either. And it's reimbursing myself any out-of-pocket health expenses from the point of the plans being created on down. So I can be reimbursing things that I'm incurring now, 20 years from now, out of all that growth and all that money. Yeah, it's that potent. It's very effective. A lot of accountants call it the triple threat. because you get a tax deduction going in, you pay no tax on the growth, and you pay no tax on what's coming out. There's nothing better than it. That's it. That is a great plan. The only knock on it is it's only $8,550, $8,550 for a family per year that you can write off. So it's like slow clap. I wish it was bigger for some of you higher income folks, but you could still use it and go nuts, grow that thing. I have one, and I've done really great inside it, and it's kind of fun to watch because I know that money's going to come out and cover my medical expenses, including the stuff that I'm incurring now. I get to write it off. Now, if you're somebody who just wants to write off your medical expenses and you're not getting any luck on your Schedule A, in fact, it's really frustrating. You have to exceed 7.5% of your adjusted gross income, and you're really mad, and you're like, I never get to write anything off. I'm using the standard deduction. You could use that HSA, fund it, and then reimburse yourself. And you just wrote off your medical expenses. So it's number 4, and it's a fantastic tool. And number five, this is going to be for those of you guys who are kind of nerdy McGirties, is understanding the types of income that you have and knowing that they're not all created equal. So for example, if I am making $1 million a year as a W-2 employee, that's far different tax than if it's dividends, which is far different tax than if it's distributions out of an S corp or rents or fill in the blank. So there's different types of income. My favorite is dividends because it's taxed as long-term capital gains. If it's qualified dividends from a U.S. company, those things for a lot of Americans, the average American, your tax rate on those is 0 because you're in the long-term capital gain category. If married filing jointly, I think it's $96,000 and below in 2025, where you're not going to have to pay tax. It's 0 if that's the type of income you're making. So dividend income is absolutely fantastic. Long-term capital gains aren't bad. They're 20% plus the, if you're in the highest brackets, you're going to also have the net investment income tax, 3.8% surcharge. So it's 23.8% federal. But that's a lot better than 37% if it was salaries and you're making active income. So there's a big difference. My favorite type of money, though, and let's talk about what the wealthy do, when you lever an asset and you take the cash. So if I have real estate, it's gone up in value. So I bought a house for $100,000. Now it's worth $500,000 and I borrow $300,000. How much tax do I pay on the $300,000 that I borrowed? 0. Loan proceeds are not taxable. There is a slight exclusion if you're doing, if you're not at risk on the loan. So if you're in a syndication and somebody gives you more than what you put in, you might have a taxable event there. But for most of us that are just going out and doing our own stuff and we have the real estate and we get a loan against it, like against our house or something like that, I could borrow. I don't pay any tax. 0, zilch. And I can borrow against my stock portfolio. It's called a security back line of credit. No tax. I'm not selling it. I'm not selling that asset. I'm just levering it up. So that's absolutely fantastic. What other types of income give you huge benefits? Tax-free muni bonds. It means exactly what it is. It means that I might be doing bonds, but they're tax-free, both for federal and state purposes. We love that too. What's another great investment and income type? If you like oil and gas, you could actually get a deduction up to about 80% of what you put into it if you're doing a working interest in oil and gas. But again, talk to a professional before you do these, but there are different types of income out there, different types of investments that some of them are tax advantaged. Again, I've done a lot of videos on these things. You can go in there and play around on the site, subscribe, like, do all that good stuff, and then spend some time learning some of these things. And you might be surprised how much money you jam back in your pocket. So that's the 5 tax hacks for 2025. We have a lot going on. You want to make sure you're watching Congress because we have the Tax Cut and Jobs Act expiration on a bunch of those provisions. Some of them are permanent. Watch some of my other videos on theirs and it'll tell you which one's which. But there's a lot going on. So make sure you're paying attention because this year is going to be very active for you tax folks. And for those who want to spend a little bit of time on a channel such as mine, the benefit's going to be immeasurable. It's going to be thousands of dollars back in your pocket when you start implementing a few of these strategies. But I just threw 5 at you. Hopefully you grab one by the horn and get some benefit out of it. If you know anybody who would benefit from these strategies, share it with them, like and subscribe, and I'll see you later.